Hey traders, this is Blake Morrow with Traders Summit, and I have Mr. Jim Welsh here. It is Friday. It's good to see you, Jim. How are you?
It's good to see you, Blake. I'm doing well. Hope you are too.
I am. It's been a very volatile week. So, as
Yep.
traders, we tend to thrive on the volatility. And it was really interesting. The price action this week, you saw the dollar just kind of getting hit, yields falling. PPI was strong.
Yep.
Market didn't care. It was just seemed like just such a bond move. And I
Yeah.
was explaining to some traders earlier this week, it was like a pendulum. And CPI hit, the pendulum went whoop right the other direction. And we saw some really good dollar strength, and we're ending the week with the dollar kind of up in everybody's face. So,
Right.
what do you make of all this crazy price action? I mean, did the PPI and CPI change your view on how you see the Fed? You've been very much in the camp. Fed's not going to do anything. This month they're going
On
to
November 1st. Yeah.
on November
No,
1st they're going to
nothing.
keep rates unchanged.
Yeah.
So you still in that
No,
camp?
I still think that that's the case for many reasons. And I think what we've seen this week on balance with various speeches that numerous Fed governors have given is kind of, let's be a little more patient, even those who are tilting toward raising rates more.
There was a lot
Now,
of the commentary this week. A lot.
right,
Yeah.
right. And again, I think, the Israeli war situation creates another level of uncertainty.
Yeah.
And, again, I think the Fed is aware of lag effects. It's not like they have disappeared completely, although, there are some that think, well, maybe they've come and gone. We talked about this in the last 2 weeks. But no, my take has been is the Fed would hold what I think the CPI does put in place, and the GDP report that comes out before they meet for the third quarter, it's going to be 3%. It might even be a touch. It's going to be much higher than under 2%.
Yeah.
So to me, what that puts in place is, we didn't raise rates November 1st, but every meeting's a live meeting, and we'll respond if we need to. Because again, the Fed wants to see inflation come down, but they're also looking at economic growth softening. Again, if you look at their projections, and we've done this, it's both what they think is going to happen, and I think there's also the element of what they hope will happen. And what they put in at the September meeting was GDP growth below 2%, in other words, below its long-term trend for both 2024 and 2025. Without the unemployment, 4.1 on the unemployment rate for both years. I mean, that's not going to happen. But my point is that they want to see growth slow under 2%. And so when that third quarter GDP number comes out, Blake, it's just going to reinforce, I think, higher for longer messaging and potentially, leaving additional rate hike or hikes on the table.
All right. Well, we're going to obviously, as traders, we are very much data dependent at this point. We'll be taking it all in. I got to ask you this before we start jumping into your charts, the charts that you brought for us. Here we are at the end of the week. Markets are a little skittish. Is that appropriate based on the current environment in Israel and
I think so. Yeah, I mean, I think what's happening is a realization with Israel basically telling people you need to vacate this area in Hamas or in Gaza.
Gaza, yeah.
In other words, they're going to start blowing stuff up in mass. We've seen the reaction in oil prices, obviously in gold. We'll touch on that a little bit more. So I think there should be a level of uncertainty above and beyond, because we're going to see an escalation. And my take when I got back on Tuesday, I wrote my weekly technical review on Tuesday instead of Monday. And my one comment was what Hamas did is almost seemed like baiting Israel to do their invasion, and whether that is already been rearranged or prearranged with Hezbollah to begin as soon as that happens, then strike Israel from the north. And so now all of a sudden Israel is in a two-front war, which obviously complicates and raises the bar. And I don't think anyone doubts that Iran, who has funded both these groups for a very long time, is involved to some extent in the decision making. And then that opens the door to potential more escalation. So yes, I think jitterishness and unease is very appropriate.
Jim, I'm excited to get to your charts, and we're going to get to them in here in 1 second. I just have to say that if you guys and gals appreciate what Jim does, make sure you give him a big thumbs up. You've been looking for gold to drop below 1850, and you're looking for a long and possible reversal to all-time highs. And it's interesting. A few weeks ago, we talked here. You can go back and look over the last couple of weeks. We talked here, I don't know what the catalyst might. I don't know what the catalyst might be, but it's something that's going to drive gold prices higher. And here we are ripping. I mean, we're at 1922. We've been as low as what? We were at 1820 or 1810. I forget we'll look at the price here in a second. Yeah. But gold has absolutely come out of its shoes and is ripping, and your technical analysis has been so on point. So for those of you that appreciate what Jim does, each and every one of you, it's free to do this. Just give him a big thumbs up and jump down in the comments below and tell him what a great job he does every week. All right, Jim, without further ado, let's talk about the bond market, and let's get into how you're seeing bonds, because obviously this is kind of tricky. And I have to say, I've been looking at this inverted head and shoulder pattern on a 10-year daily chart, but your TLT should kind of show that. And
the first chart is a very long-term chart.
Okay, so this is a weekly chart.
This is weekly, but there's a chart I sent you before this one, I believe, that would be helpful if you grab that one first.
Oh yeah, the secular market. I thought I had it here, but here it is. So my fault.
So because the implications of this chart extends beyond the bond market. So what we can see is, as we know, bond yields peaked back in the early 80s, 1981 to be precise, and this is bond prices. And you can see, obviously, an extremely well-defined uptrend in bond prices.
I have friends that have made their whole career on this move.
Yeah, well, talk to Bill Gross and others, okay?
Yep.
So, and what do we know? The stock market bottomed in 1982 and on balance has enjoyed a continuous secular bull market. And I think a large prop making that happen has been treasury yields coming down, 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 supporting higher PE ratios, obviously stimulating economic growth. For the last few years, allowing companies to borrow money near 0% and then buying back their stock. So they shrink their float, they goose earnings in the process of doing that. And so what this looks to me is like the death of the secular bull market in bonds that's been in place since 1981. Now, I wrote about some of this stuff back in 2021, but this chart, the other feature is from that high in March of 2020. You can see 1, 2, 3, 4, 5. So I think we're nearing the end of, if you will, the first phase of this secular bear market in bonds. What it implies is we're going to see a fairly significant rally where bond prices go up, treasury yields come down. But this 5-wave decline, Blake, implies that longer term, after whatever reflex we see, and it could go all the way back to get near that blue line, potentially. That would be the most optimistic. At a minimum, one would think it would go back to 130. But what it implies to me, Blake, is after whatever rebound we get, which I think will be inspired by an onset of a recession, that we're going to see yields go up again and take out whatever this peak they make here. And as you know, we've off and on discussed the idea of a secular bear market in stocks that maybe began in January of 2022. This chart would kind of support that interpretation, or it will begin after maybe one more, crazy rally in the S&P as yields come down back towards the 4,800 level. But ultimately, I think this is, to me, suggesting that the equity market is going to be under pressure for a long time. And there's a lot of reasons above and beyond just treasury yields. As we all know, in terms of debt, the amount of issuance and so forth is just astronomical. There's never been a budget deficit during an economic expansion like we've seen in the last 2 years. So historically, then what happens is, gee, you go into recession, and that's where you see the flood of deficits. So this is unprecedented what's happened in the last 2 years.
Yeah.
And the fact that we see a breakdown in this long 40-year chart is like, hello, wake up. So I think this is really significant. And as long as treasury bonds are below that blue line, I think the downside risk over many years has to be acknowledged and respected.
Absolutely. And so just to simplify or to sum up what Jim is saying, any move lower in yields and move higher in the bond market is probably to be sold on a longer term basis.
Bottom line, that's it.
Yeah.
All
right.
Now there could be, again, if I'm right about a recession, there could be a pretty rip-roaring rally because that's the way it always works. Now, this is TLT, kind of a little bit closer pickup in terms of that decline from the March 2020 high, pardon me. And you can see the red numerals are the wave count. If you go 1, 2, the low last October
was over
3.
Here. Sorry.
Yeah. And then that rally up to April of this year was 4. And now I believe we're in wave 5. But just looking at the daily chart, Blake, it's like, okay, I can see where we can have a little bit of a bounce and then potentially another leg down that takes out that 8406 a low before a more lasting rally, sustained rally takes hold. One of the things that can do it is that GDP report that's going to come out right before the Fed meets, and it's going to be a pretty strong number. And that could be the kind of thing that shakes the bond market one more time just before we see the economy really slow down materially over the next 3 to 5 months. So right now, I think we have to respect that there's the potential, as long as you're below that blue horizontal line, that you have the potential of another leg down. And those two moving averages, the 5 and 13 expos, the red's below the green. So momentum wise, you don't have anything to tell us that for sure a reversal's taken place. The RSI got extremely oversold. More often than not, you'll see a bounce and then another leg down, ideally some kind of a divergence. So last when we talked, I said the chart, which was on Thursday, the chart allowed for 10 and 30-year treasury yields to go higher one more time. They did. Now I think there's still that chance that there's even just one more time that's going to happen. But from a trading standpoint, I think we're at the point where one wants to look for an entry in TLT. And if there's a decline below 8406, I think you should be a buyer of it, because I think there's a pretty meaningful rally coming, that will probably extend through the first half of next year.
All right. Well, Jim, that's how you feel on the bond market. Let's take a look at how you feel about the dollar, because the dollar has been very whippy this week. It's, we had that situation where it's like, where did all this dollar weakness come from? But CPI hit, dollar ripped, yields have, moved higher. So what's going on?
Well, the key level to me was the 105.65. This is what I wrote about Tuesday. I think we may have mentioned that last week, saying, okay, what do we need to see happen in order to confirm a dollar top? Well, we need to see it close below 105.65. You can see 2-3 days this week, it kind of tested that level, dipped intraday below it, and then we've seen this rebound. Yeah. My expectation in my Tuesday note was that we could see a rebound to 106.40 to 106.60. But the door is still open that you could see a move above the 107.34 to make another new high here. So ultimately, do I think the dollar is going to drop below 105.65? Yes. I think we're going to get, like, in other words, this pullback to that support was wave A. We're getting this bounce to where we are today is wave B, and then another leg down. The alternate count is, hey, we'll go up and make a modest new high and then have the correction kick in. And I think taking it down to 104.40 or so, ultimately, I think that's where the dollar's going to go. Longer term, after this pullback, if it shows up, is done, I think the dollar is going to go up again and rally in coming months. So, whether it's geopolitical or monetary, I don't know. Sometimes there's just no way of knowing. The price pattern suggests as long as you're holding above 104-ish, I think you have to respect that after any pullback, the longer term trend is positive.
It's amazing how these patterns play out, and we're gonna go into it, and talk a little bit about gold in a bit. But gold, we didn't know that. You didn't know. We didn't know when we were talking last Friday. We did not know that was going to happen. Right. So I mean, things appear and these patterns take hold. So
that's why technical analysis, I think, provides. We're trying to figure out this big puzzle. And you got to look at fundamentals, I think, and understand them. And the fundamentalists rarely use charts. And then the technicians pretty much exclusively only use charts. There aren't many people that I think develop the skill level to understand the fundamentals and chart analysis and then put them together. I've been doing this for a real long time.
Yeah.
And that to me has always been, Marty Zweig has kind of set me on this path from in the mid 80s in terms of how he approached markets. And so to me, that's where it becomes very important. To your point, the charts were suggesting that gold was nearing a very important low. And, we needed one more dip below 1816. I thought last week it could actually extend below 1800 before we got the reversal. Instead, it got to 1812, rebounded, and then obviously exploded today. But the charts were kind of saying this is what's setting up. And you're right. It's amazing how something shows up and kind of manifests it then in price action.
Well, remember, if you guys want, Jim's most recent report, email him at Jim Welsh Macro
at Gmail,
and he'll send you the most recent report.
Yep.
And also tell him that you saw him on the Trader Summit. All right, Jim, let's get back to your charts. Here's your S&P chart. This is a mess to most people. So explain what you're seeing.
Well, I think, as I say, crossroad. When the S&P got up to 4607, you and I talked back in late July that things were setting up for a 5 to 7% correction. The S&P actually intraday pulled back to about 7.9. You can see ABC, as I have it, in the green little, markings. Okay, ABC, you had that long-term trend line you kind of held. 4,200 is kind of important, got down to 4,216. And if we got this three-wave decline, it implies that, all right, we're rallying above 4,607, a possibility of going up to the all-time high again. And that's a pretty bullish count. The alternate count is way more bearish. It's kind of like one down, two up, one down, two up. And now you're about to go into wave 3 of 3, which is the most intense part of any move, whether it's up or down. And in this case,
you haven't marked it like below 4,000, but wave 3 could really be down here.
Yeah. I was directionally what it shows. Okay. Because what this, it's like 1, 2, and then 1, 2 for the first part of 3, and then 3, a bounce, 3, a bounce, and then 5, so yeah, you're 100% right. It could be much lower. So to me, that's where we're kind of at. And if I thought that, we were going to see a resolution to monetary policy, we don't even have that really. Obviously, the Middle East adds another layer of risk in terms of what kind of response do other entities in the Middle East generate if and when Israel goes into Gaza, and what does that mean? How extensive is it going to be? So it's easy to make a case for wave 3 to 3. So to me, it's just, again, sometimes there's times where you just can't know. You just can't go. We can make an educated guess, and a lot of times be more right than wrong. This is one of those times where we can make an educated guess, but overnight things could change dramatically. So,
well, here is your short-term chart. So does this paint us a different picture?
well, this is kind of like saying, all right, if we're going to get that ABC down, the bullish resolution is that, all right, from 45.05, we began wave C. So we got one down, 1, 2, 3, 4, 5 for wave 3. And then you had that rebound to 43.33. I think based on what we saw subsequently, that would have to be labeled wave A. The drop to 42.16 is B. And then we've had this rebound to the high this week for wave C of 4. And that you'd get one more drop below 42.16 that isn't, like, oh, the world's coming to an end type of drop. Goes down, tests 4,200, maybe takes it out by a little bit. Then, that would say that pattern then would imply a rally back above 46.07. So all this is, in the prior chart, I gave you two paths. We've got it where we're going to make a low and then rally above 46.07. This is the detailed look at that. And even here, to me, the odds favor a dip below 42.16 to complete the decline from 46.07 as a big ABC with 5 waves down for wave C before that rally kicks in. So, and again, I think, the dollar treasury yields are going to have a great influence on the market. The catch-22 here is, depending on geopolitical problems, you can see dollar strength and treasury yields come down that have nothing to do with the U.S. economy and Fed policy and everything else. Just the perception that, wow, this has escalated significantly and it's going to have an impact on monetary policy, and then obviously ultimately then on monetary policy. So we're at one of those junctures where, to me, it says trade smaller than you normally would.
Yeah. All right. Well, let's wrap it up with gold. Like I said, you nailed this one really good. We were racking our brain, like, what's going to take it to new highs?
Yeah.
Well, now we know what has the potential, right?
Yeah. So you took out the 1816 low, then you got to 1812, and bingo, getting above back in that channel, which it did a day or so ago, was constructive. You can see that downtrend line that we're pressing and maybe nudging slightly above it. My take is, I think wave 3 to an all-time high has more likely begun. The other count is a B wave that would probably get you up towards 2070. But, to me, this is saying it's time to buy gold, and we'll see what happens next. I would be very surprised if you don't get a rally at least to that 1980, and potentially to retest the 2050, 2070 level. But again, the price pattern implies that the probability of wave 3 having begun has tilted to more than 50%. And we've been waiting since that high in May for the wave 2 to complete.
Yep.
And so, okay, the pieces are in place. As I said, you can count 3 waves down. So there's 2 paths. Either wave 2 is completely done and we're off to the races. The other count is that 3-wave decline is wave A of 2. We get a pretty significant rally here for wave B of 2. And then you're going to see wave C of 2 that undercuts this low before wave 3 begins. And as I said, the chart pattern on the dollar implies, yep, we're going to get a pullback to 104 to 105, and then it's going to a higher high. So that would suggest that alternate count on gold is possible. But near term, I think the trend is higher, and then we just have to navigate what happens in the next handful of weeks. The interesting thing is, we know the correlation between the dollar and gold has been unbelievably tight for quite a while now. And what's happening today is other stimuluses are outweighing dollar strength. for obvious reasons.
And everybody should understand that gold and the dollar, they tend to have a very inverse relationship, as Jim is pointing out. But there are times, especially times where the market's a little stressed, where gold can go up, dollar can go up, and bonds can go up. And
right.
That's like one
of those unique
nasty
periods.
sandwich, right?
Yeah. And we know, gold has disappointed people for quite a while, and breaking down below 1900 and then below the 1880 and then below 1850. I'm assuming that there's some short positions that have built up, and that's why a rally up to 1980 seems like a gimme. So again, to me, the pieces finally have fallen in place. Therefore, you want to be long gold, and then we'll just navigate what happens in the next handful of weeks in terms of what unfolds in terms of the chart. Does it break through resistance and all that in the pattern? If you see 5 up, that would be the most bullish thing I think we can see longer term. So there's no way of knowing if that's going to unfold yet or not, but just based on all the analysis and discussion we've had for 5 months, we're there. So
well, Jim, if you don't mind, I'm gonna send over a Powerball empty one, if you don't mind filling that thing out for me. I'd appreciate it. And I'm sure everybody here at the Trader Summit would appreciate if you did the same for them. But we're just going to make it exclusive for me. Jim, okay. I want to thank you for each and every week spending your time with us and walking through the different scenarios in the market. And once again, if you all appreciate what Jim does, make sure you check him out at Macro Tides and send him an email at jimwelshmacro at gmail. Tell him that you saw him here on the Trader Summit. We'd appreciate it. And Jim, we do appreciate you. I do want to say that. And thank you so much.
Spread the word. Spread the word. Appreciate it. Just as an aside, I don't want to dampen your enthusiasm regarding the Powerball. On Wednesday, Heidi bought a couple Powerball tickets. Why not? Out of the 12 numbers, we got 1.
Yeah, I think that was about my
hit rate last
time I tried. Yeah. So
yeah. So there's no insight coming on that one, guy. Our odds are equal. 1 in 292 million.
Right.
Lucky today, punk.
Thanks, Jim, for your time.
Right, thanks.
Much appreciate you. Have a great weekend. Okay.
All right, Blake. Take care, man.
We'll see you next week. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.